It's showtime! Hey everybody, John King with Summit Funding. It is noon Pacific time on Friday, June the 3rd. In case you're keeping count, you have 3 shopping days left until my birthday. I know, everybody's been waiting. You've been counting it down. You got it circled. It's Monday, just so you know. I want to give you advance notice. It's Monday. Anyway, guys, thank you very much for joining me. Every single Friday, I come to you with a different topic to help you grow your finances. It could be ranging from any number of things that have to do with mortgages and specifically how to build wealth through real estate to topics having to do with just how to manage your finances, how to manage your retirement, or how to help other people grow their wealth through real estate. And so I really appreciate you joining me for my Financial Friday broadcast. All right, so today we're going to be talking about a topic that's near and dear to my heart. And it's a question that I get all the time from clients, from family members, from past clients. Hey, John, I want to help somebody buy a home. I want to help them with their finances, but I'm not sure if it's a good idea. I'm not sure how to go about it. I'm not sure what steps to take or even where to start. And so today is really my goal is to help you know where to start and how to have that conversation, both how to have the conversation if you're a home buyer who is saying, hey, I want to buy a home, but I know I can't make it. And I know I can't do it on my own. I need some help. I'm going to give you some things that you have to think about. And we're going to think about categories. We're going to think about what circumstances are you going to be in where help really helps, because sometimes help doesn't help. And I think that some of my clients have the tendency to say, hey, John, I just can't do it on my own. I need a family member to help me buy a home. And you might be right, but sometimes you're wrong. And sometimes you don't need that family member. And as a matter of fact, there's some negatives or some drawbacks to having somebody help you with buying a home that I want to explore with you today and help you understand, is this a good idea or not? And maybe you're able to do it on your own, or maybe we can think about it a little bit different and be creative. One of my favorite things is being creative and using my knowledge of the mortgage world and the real estate world to help you figure out, how do I navigate these waters? How do I help myself, or how do I help a family member buy a home that can't do it on their own? So really, that's what we're going to focus on today, is diving into what does it look like? What are the pros and cons? And how do we make this really work well for all parties that are involved? So whether you are a family member looking to help somebody become a homeowner, whether you are the person looking to become a homeowner that says, John, I think I need some help, or if you're an industry party, if you're a real estate agent or anyone else as a professional that advises people, that says, hey, you have questions about home ownership, I think this is really good education to help you understand how to navigate those waters and what options you have, some of which are super, super obvious, some of which are not. So I'm super excited about this presentation and helping guide you down this road over the next, about the next hour. So let's go ahead and get started. First of all, why are we even talking about this? Home ownership is one of the biggest ways to help build wealth in America is through home ownership. And as a matter of fact, next week on my Financial Friday, I'm going to be talking about the pros and cons of home ownership versus renting. I think that there is a contingent of people out there right now who think, you know what, you're better off being a renter. You don't have to worry about repairs on the home. If something breaks, you call the landlord. You don't have to worry about property taxes. There's a lot of truth to those things. And next week, I'm going to be talking about the full deep dive into why should you stay a renter? Why should you become a homeowner? But the fact is, I am team homeowner, full disclosure. I fully believe in home ownership. I think that it is great to help you build wealth and to have stability. And for most people, those are two super, super important things. But there's hurdles in the way for people to be able to become a homeowner. And those hurdles get them distracted or cause them to delay when they actually can become a homeowner. And the challenge is people think about timing the market. Right now, everybody's like, oh, hey, is it a good time to buy? Is it a good time to sell? Timing the market, that's one way to look at it. I'm a believer of time in the market. And when I think about time in the market, the earlier you get in the market, the better off you are. The longer you own a home, the better off you are. And so my goal today is to show ways to strip away the hurdles, to find ways to help you or someone you love become a homeowner and be able to share in the opportunities of wealth building and stability that comes through homeownership. So the first thing is I want to talk about the building blocks of this, the ways in which you can help somebody who needs assistance. Again, whether you're the one that's buying and needs help or you're the one that's giving the help, the fact is there are 3 ways that you can help. You can help with money. So that's cash, and we'll talk about cash issues and what those are. But the first way that you can help is with money. The second way that you can help is with credits. Now, credit sometimes means I need to help bulk up the credit of the person who's buying. Well, maybe that's as simple as giving them some money to pay down some debt so that their credit scores can go up. The third thing you can help with is income. Income comes typically from cosigning, where we're adding your income with theirs and putting you guys together to determine that you qualify for the mortgage. And so I'm going to spend a little bit of time, a fair amount of time, talking through those 3 things and helping to dissect each one and give you some specific examples of how you can help when somebody's looking to buy a home dealing with these challenges. So the first challenge we're going to talk about is cash issues. Now, when I say cash issues, first of all, cash is a 4-letter word. It is not a good word. We're not talking about green pieces of paper with pictures of presidents. When I say cash, I'm talking about the money you have for down payment and closing costs. It is the number 1 hurdle to purchasing a home is not having enough money for down payment and closing costs. So I want to give you guys some thoughts here. I actually have, I'm going to do something different. I've got my iPad with me, and I'm going to be sketching out some ideas on here. So hopefully you guys can see this pretty good on here. When you're buying a home, you have to come up with 2 things to purchase the home. You have to come up with down payment. So you got your, oops, let's put the pen on here. You've got your down payment, and then you have your closing costs. Okay. So your down payment is going to be, your down payment is going to be depending upon the loan program that you're doing. So if you are putting an FHA loan, you need to have 3.5% down for an FHA loan versus if you are doing a conventional loan. So a conventional loan is going to be anywhere from 3% to 5% as the minimum down payments. So you've got to have that money. Let me use some simple math here and say, hey, if we're buying a $500,000 home. So our $500,000 home, we're talking about for a conventional loan, we're talking about $15,000 is our 3% down to $25,000 is our 5% down. Okay. If you're doing FHA, now we're talking about $17,500 as our down payments. A lot of homeowners don't have the money to come up. A lot of potential homeowners don't have the money to come up with that down payment. Plus, we have to come up with closing costs. So closing costs are going to be money to pay the lender. So my company charges $1,525 for the work that we do. Now, there's other companies that might charge $900. There's other companies that charge $2,000. The fact is we are middle of the road on what our hard cost is. That's for things like underwriting of the loan, processing of the loan, things like that. You're going to have an appraisal fee. Your appraisal fee is typically going to be $500 to $600. You're going to have title companies' fees. The title company's job is to basically be Switzerland, to be the neutral third party that is helping you to confirm that, hey, when this house is sold to you, it really is going to belong to you. And they also are going to swap the money. They're going to make sure that, hey, as the seller signing over the ownership to your home, they don't want to sign over the home to you until they know that you've brought the money. But you don't want to give them the money until they've signed the homeowner. So the title company does that research. They're charging between, depending on how it's split, it's $1,000 to $3,000 for title companies' fees. Okay. Then you've got what's called prepaid expenses. Prepaid expenses is going to be property taxes, homeowners insurance, and interest. That can be another $2,000 to $4,000 in expenses. And the final thing you have is points. You may or may not want to pay points. In today's world, There's a bigger benefit to paying points. I have another video I talked about where I called it the death of the 0-point mortgage. So we'll link that one down below. But the death of the 0-point mortgage explains, hey, you probably are going to plan on spending money in points, and points is typically 1% of your loan amount. So now, if we're borrowing, $480,000, your points is $4,800. I tell my clients this total of closing costs is anywhere from $10,000 to $15,000 on average. So I'm telling you that for somebody to buy a home, they're going to be looking at needing about $15,000 in down payment money, and then another $15,000 in closing costs. They're going to need a total of $30,000 out of pocket to buy a home. I don't know about you, but $30,000 is not something the average first-time home buyer has. And so when we think about down payment, we think about cash. What we're thinking about is, how do you come up with that money, and where does it come from? And the good news is there's lots of ways you can get the money. And really, your down payment can be paid by one of three ways. It can be paid by you as the buyer, having your own money, checking account, not credit cards, checking account, savings account. If you have money in investments or 401k, that's your own money. The second way you can get it is a gift from family. This is where the topic comes in, because you can use family gift to come up with your down payment. And the third way that you can pay for your down payment is through a down payment assistance program. I have another video that I'm going to link down below about down payment assistance options. It's an hour-long video I did on a Financial Friday about a month and a half ago that talks all about down payment assistance and how all of that works. I think it's super valuable if you're thinking through all of this to weigh the pros and cons. As a buyer, if you're saying, hey, I've got mom and dad that are willing to help me out, then you don't necessarily need to use down payment assistance. The question is, do you want to? Well, there's a lot of considerations to this. First of all, the money you get from family is typically the least expensive, because rarely are you paying it back, or if you are, you're not paying it back with any interest. But it doesn't come for free. There's a pretty high emotional cost. The truth is, guilt. I grew up as a Catholic. Guilt was a powerful tool as a member of the Catholic Church, and I'm only partially kidding. And the fact is that a family member gives you money to go for your down payment. They might feel like, hey, I have kind of an ownership stake in your home, or you owe me because I helped you buy your home. So there's a cost to getting help from family, but it's significantly cheaper financially. Because even down payment assistance, it's not free money. You'll see in the video that I linked down below about down payment assistance options, there is no such thing as free money. But it is the only three ways you can pay your down payment is your own money. If you don't have your own money, it's either a gift from family or it's a down payment assistance program. Now, when we shift to closing costs, and I talked to you about $10,000 or $15,000 on average for closing costs, those closing costs can be paid for using the same three methods. You can pay for them using your own money, you can use a gift from family, or you can use down payment assistance, but there's two extra options. The next extra option is using a lender credit. Now that means that as a lender, I'm not just giving you money to pay your closing costs out of the goodness of my own heart. I do have a good heart, but the industry is not going to give you money to pay for your closing costs just because we're nice. Your lender credit is coming because you're paying a higher interest rate over the life of the loan, and only if the numbers work. I talked a few minutes ago about the video that I'm going to link down below called The Death of a 0-Point Mortgage. Well, guess what? A lender credit is actually a negative point mortgage. So there's paying points to get a lower rate. There's paying 0 points to get a higher rate. And then there's me paying you points to credit you back money, which is even a higher rate. And in today's world, that's almost impossible for the reasons that I explain in the Death of a 0-Point Mortgage video. So check out that video. So here's the deal. The last way that you can pay for closing costs is through a seller credits. Now, seller credits, again, a seller is not going to give you money out of the goodness of their own heart either. But here's what a seller is going to do. A seller is going to be willing to give you a credit if the ultimate bottom line you give them is greater than what anybody else is offering. And right now it is June 3rd of 2022. We're in a shifting market. Now, I'm not saying that we're going to a downward market. I don't think we are at all. But we are definitely in a shifting market where instead of having a super white hot seller's market, meaning there's 20 people writing an offer for every single home that's listed, now we might have 1 or 2 people writing offers. We might have homes that are sitting on the market for 2 or 3 weeks and the sellers overpriced it and they need to lower their price. But you have an opportunity to jump in right now and offer them full price with a credit towards your closing costs. You could get all $15,000 of your closing costs theoretically paid for by simply offering the seller their full price. They were likely about to lower the price anyway. So instead of lowering the price by 20 or 25 grand and hoping somebody comes along, you simply gave them a $15,000 reduction in their profit, in their cash back to them, and they got the deal put together. It's a wonderful opportunity right now. But again, that's not my focus on today. My focus on today is the family help. So if you are using help from family, or if you're giving help to a family member to pay for their down payments, you do not need to be an owner of the property. Now you can, and this is a consideration on how much control does the donor want to have. Here's what I've run into multiple situations, and the whole point of this video is to describe some of these situations. I've run into situations where a parent wants to give $100,000 as a down payment to buy a $350,000 home. I know, John, that's not realistic numbers. Where's a $350,000 home today? Well, I'm using an example from a couple of years ago. And the parent was super, super clear. Look, I don't want my kid being able to go tap into that $100,000 I gave them. Like that, I put that as down payment money. And technically they could go get a home equity line of credit against the home and borrow that money. And I don't trust my kid. I'm not comfortable with them doing that. Well, in that case, the advice was for the parent to be on title as an owner of the home. Now, that technically means the parent is splitting any appreciation or equity growth in the home. Hey, if that's what you guys want to do, great. But more importantly, it means that the parents has to agree to any new loans that are done, including agree to selling the home. Now that handcuffs the homeowner, that handcuffs the child in this situation, saying, I can't do anything with this house unless my parents give me permission to do it. That's a question for the parents and the children to decide. But there are times when, hey, free money comes with conditions. And you don't have to be on title when you give a gift. And as a matter of fact, most people prefer not to. It's simply a gift. But the G word, gift, major tax problems in most people's minds. Now, I got to give you my disclaimer. I wish I had it on the bottom of the screen here, but the fact is I'm not a tax advisor. I don't play one on TV, and I'm not licensed to give tax advice, but I'll tell you anyway. Here's the deal. When you give somebody a gift, we are requiring that the donor writes a letter or signs a form that says this is a gift, no repayment is required. If your recipient wants to pay you back later, they can regift the money back to you in incremental dollar amounts. I don't really care. The fact is that you have to sign a letter as the donor saying this is a gift, but people freak out. Oh my God, John, I'm not willing to do that. My parents won't sign it as a gift because then they have to pay taxes on it. Well, this is how it works. Again, not a tax advisor, not giving tax advice. In general, the IRS wants to make sure that people don't give away their entire estate while they're alive and not pay inheritance taxes on it. Because the IRS makes a bunch of money when wealthy people pass away, and they pass on their estate to their family members, and the IRS gets to tax that. And this is the IRS's way to prevent somebody that has millions of dollars in their estate of just giving away, hey, I'll give you $1 million this year, and I'll give you $1 million next year. And that way, by the time I die, there's nothing left for the IRS to tax. So here's how the rule works. There's a cap each year of the most that the IRS lets you give without having to report it to the IRS. That's a cap per recipient. So if you're married, your parents could give up to the cap to you and to your spouse, and it would not trigger the reporting requirements. If you give a gift greater than that amount in 1 year, it triggers reporting to the IRS. It does not trigger taxes. It triggers reporting the gift because the IRS keeps a second tally of how much money you've given over your lifetime that exceeds the annual amount you're allowed to give without a problem. So every year you get to give this much money to each person, but if you give more than this much, it counts towards this bucket. And that is a lifetime cap. I'm not going to tell you the dollar amount because it changes, and I'm not allowed to give tax advice. But the fact is, you can still give up to that lifetime cap and you pay no taxes on that either. But every dollar you give over the minimum is money that applies towards that lifetime cap. So if you have a family member who is prolific in giving away money and they've given away a lot of money over each of the annual caps, that's when they can get in trouble and start to have a tax bill with the IRS. That's not the case for most people. So it's something to truly understand. You can give a gift or get a gift, and there is likely zero tax consequences to that. Thank you for the thumbs up, Sylvia. Great to see you. Great to have you here. So guys, by the way, if you're watching live, feel free to post a comment. Give me a shout out. Tell me what you like about what I'm talking about. If you're watching recorded, do the same. Give me a shout out on what you like about this. I'm covering a lot of detailed information I think is super, super valuable in helping you evaluate how to assist family members in buying a home. Okay, so cash issues are solved typically through a gift, and a gift does not require you to be on title unless you want to, but it has to be signed as a gift letter, and there is rarely any tax consequences to writing it as a gift. So hopefully that explains the cash issues and how you help people who have a hard time with coming up with that money for the down payment. All right, so the next thing that we're going to talk about is credit issues. Now, credit is complicated. Credit is the evaluation of how well you've paid your bills in the past, because that's the best prediction for me as a lender, for the industry, to say, well, how well are you going to pay your bills in the future? And credit in general is not helped by a cosigner. Now, I have one major caveat. It's a new rule that came out last year that I'm super, super excited about. But in general, if you have a low credit score, having a family member co-sign with you doesn't change the fact that you have not had a good history of paying your bills. Let's think about this for a second. You're buying the home, you're going to live in the home, the bill is going to get mailed to you every single month. You're receiving the bill, you are having to open the bill, you're going to have to go to your online banking, you're going to have to schedule the payment to be made, you're going to have to prioritize this, and your credit history shows you've done a poor job of prioritizing that. The bank and the mortgage industry is worried. Are you even going to remember to pay the mortgage? Do you care? Are you going to pay attention to it? Or are we going to have to chase you down and incur losses due to interest charged because you haven't paid us on time, lots of attorney's fees, that kind of thing? That's what we're worried about. Having a cosigner does not help you remember to open your mail. Having a cosigner, having mom and dad, having a brother or sister cosign for you that lives in a different house in a different city or even right next door, they're not opening your bills. You are. So typically, cosigners don't help with credits. Typically, I'll give you a couple of examples here where there's ways, some loopholes we can make this work. But typically, cosigners don't help with credit. And as a matter of fact, the only way a cosigner helps with credit is under circumstances, well, one of the ways I should say, is when you have, let's say, a married couple, and one party has great credit, 700 FICO score, the other one has a 500 credit score. Well, if I have two people on the loan, in most circumstances, I have to take the lowest of everybody's credit score. So I'm using the credit score of the 500 person. The only way to use the credit score of the 700 person is to get rid of the person who has the 500 credit score. Okay, John, let's get rid of that person. But I can't use their income anymore. Because if your name is on the loan, I'm using your credit. If your name is not on the loan, I can't use your income. So now you might end up in a situation where, okay, my spouse that has a 700 credit score, I can use their credit and I can use their income, but it's not enough to qualify for the mortgage. I need the income from that spouse that has the 500 credit score. That's where a cosigner comes in, because a cosigner can add extra income, and we'll talk about income issues in a minute, but a cosigner can add extra income to make up for the lost income. So I'll go through the example of how the income works in a couple of minutes. But one of the ways we deal with credit is to kick off the borrower that has bad credit and only include the one of the borrowers that has good credit. Now, John, what if it's only me? What if both of the borrowers have bad credit, or there's only one borrower? Can we kick that person off? Well, now we don't have an occupant, because to be an owner occupant, you qualify for the small down payment and the best interest rates. The person who's occupying the property has to be on the loan, with an exception that I'll talk about later. So the fact is, if you don't have an occupant, now, yeah, can my family member buy the house for me? Sure. But in most cases, they have to call it an investment property, which means your down payment is much larger, your interest rates are significantly higher, your fees and monthly payments are higher. And so if we can keep the occupant on the loan, at least one person that's going to occupy stays on the loan, we're in much, much better shape. So one of the ways that we help with credit is we help by getting rid of a low scoring borrower and use a cosigner to make up for that income. Another way we help with credit issues is cleaning up somebody's credits. The problem is we all make mistakes. We all get in trouble. We all get behind. And the truth is, once you've dug the hole, it's really hard to dig out. You end up with a position, maybe it was COVID related, and you end up in a position where you were out of work for 6 months and now your bills stacked up. Well, now you get back to work. You can afford your normal bills, but how do you catch up on the old things? And so sometimes family help is as simple as, hey, mom and dad, can I get $5,000 to pay down these bills? I can do everything else on my own. If I get these bills paid down, John says in 45 days, my credit score will bump up from a 500 to a 650, and then I can qualify on my own. So that's another example of where you can help somebody without co-signing, without being on the loan with them, but give them the money they need to get out of the hole that they're in. That is super critical and super, super valuable when it comes to credit issues. Okay, here's the last thing. I'm actually going to pull up my iPad to show you this one as far as credit issues, and that is the new loophole. So Fannie Mae has a new rule that basically says we get to average the 2 credit scores of borrowers on the loan to make sure they meet the minimum credit score. So a conventional loan, so oops, don't use the highlighter when you're trying to write. Now I got, all right, perfect. So a conventional loan requires at least a 620 credit score. Now, conventional loans are very, very sensitive to your credit score, and the interest rates go up a lot when you have low credit. But your minimum is a 620 credit score. And what happens if I have a borrower that has a 580 credit score? Oops, I put that extra one, 580 credit score. Problem is you don't qualify for conventional, you barely qualify for FHA. But Fannie Mae now says, I can average the credit scores for the purpose of qualification. And so if a cosigner comes on that has a 780 credit score, then I get to average these two together to 680. If the cosigner comes on and has any credit score, I get to take the 2 credit scores and I get to average them together to use the 680 to guarantee that I meet the minimum FICO score of 620. Here's the problem. The problem is, let me open this one up here. The problem is that Fannie Mae determines risk as a very sensitive issue relative to how much of a down payment you're putting down. So this is basically what percentage I'm loaning you of the value of the home, compared with, on the left side over here, the credit score. So hopefully you can see that left side there. Let me see if I can shift that over a little bit. Okay, cool. So your challenge is, hey, you're going to say, hey, John, my cosigner has a credit score of 680. So I should be able to use this credit score right here, correct? And I'm putting, 20% down. So this right here matches what the risk cost is. So Fannie Mae says, hey, that's a pretty high risk loan. You have okay credit. We're going to add 1.75% to the cost of your loan, which sometimes translates to a higher rate, sometimes translates to a higher fee. I won't go too deep into this part of it, but I'll simply say this chart is critical because what you'll notice is when you have a big down payment, if you're borrowing less than 60% of the home value, really, we don't care what your credit score is. You could be below 620. Your risk level isn't that bad. We're only adding a little bit to the cost of your loan. So when you have someone that has a super low credit score, so we've got somebody with a 580 credit score, and we get a cosigner with a 780. The problem is we are not using the 780 credit score for qualification, because in that case, man, you could put 20% down and have that same risk factor, only a 0.5%. If you're putting 20%, though, we're going to charge you 3% extra in fee to get that loan. The point is, If you have a big down payment and you have a cosigner with a great credit score, you're actually in great shape to qualify and get great terms on the loan by using the assistance of a family member to help you when you have your 580 credit score qualify because you've added a cosigner with a 780 credit score. This is a new, I'm gonna put this away. This is a new feature. This is a new tool that I'm super, super excited about. And the point why I dug into this a little bit is to help change your thinking that says, hey, I've been told in the past that a cosigner doesn't help with credit. Well, things are changing, times are changing, and I want to help you understand what are my different options in order to best take care of myself, take care of my family member. Guys, this is where having a mortgage expert matters. Most mortgage people, you go online and you push button and get mortgage, and they just look at your credit score and say, well, based on the credit score, this is what you got. They don't understand how to be creative. And that is my skill set is A, super, super creative, B, super knowledgeable about the mortgage industry, and C, my ability to explain it in a way that makes sense. And hopefully I'm doing that today to help you understand how to navigate waters to help a family member who needs help. All right, so the third way you can help somebody is if they have income issues. John, what's an income issue? Well, income is, in my world, a pass-fail comparison. We are simply saying, do you have enough income to pay for all of your bills that you're going to have to pay? Now, that's going to include credit cards. That's going to include car payments. That's going to include your new house payments. It's everything on your credit report comes together to determine your debt to income ratio. So let me give you a simple example. I'm going to pull up my iPad here again. So what we've got is we've got just a normal buyer buying by themselves. Great job. Okay. They make $8,000 a month. And they're saying, hey, John, I've got, so that's their income. And they said, for my debt, I have a car, I have credit cards, and I have student loans. Okay. But they make a good amount of money. They make almost $100,000 a year. And so they bought a really nice car. And their car payment is $1,500 a month. I kid you not, I've seen this. They've spent a little bit more than maybe they should on credit cards. And so they've got credit card payments of about $750 a month. But the good news, John, is my student loans are deferred. I don't have to pay anything on student loans. I'm not making a monthly payment on them at all. So your student loan payment is zero. But the mortgage industry doesn't let me ignore student loan payments. It requires, even though they're deferred, that I count a payment against them, sometimes as much as 1% of the balance. So if you owe $50,000 in student loans, then I'm actually going to have to count a $500 a month payment. So now I've got $2,750 in debt, and I have $8,000 in income, and that's before I even counted a house payment. So the simple math to figure out what somebody qualifies for is we have to first know what is the debt to income ratio that we're going to allow. Every program's a little bit different, but it's anywhere from 45 to 50 to 55%. So for simple math, I'm going to call it 50%. So if their income is $8,000 a month, I'm allowed to spend 50% of their income towards their debts. That means the maximum payments I'm allowed is going to be $4,000. But guess what? They're already spending $2,750 a month. That means that they only have $1,250 left over to pay for a house payment. That's nowhere near enough to qualify today. This is what I'm referring to when I say we have income issues. Now, in some circumstances, you're going to say, John, why am I going to want to cosign for a family member? Clearly, they have these payments they have to make, and I have no intention of helping them write a check every month. That is a critical thing to think about. Super, super critical to think, hey, I'm going to cosign for someone on their loan who doesn't make enough money to pay the payment, and I'm going to cross my fingers and hope that they can afford to make the monthly payment going forward. I would be super cautious and super worried if that was the situation. Now, here's what I'll tell you. There's a lot of times where the income that they really earn cannot be shown on paper. So we use that same example and simply say, what if that $8,000 a month income was their base income, but they also earn commission? The problem is they only started earning commission 9 months ago. And I can't count that commission until they've earned it for at least 1 to 2 years. So they might make another $10,000 a month in commission. Talk about making good money. So that person has the income, but I'm not allowed to count it towards qualification. Maybe that person has a roommate that's living with them that's helping to make the payment. Maybe there's a spouse who has bad credit and I couldn't count that person's income on the loan because I had to take them off of the loan due to their credit issues, or they had a judgment against them, or any number of things that stopped me from allowing them to qualify. So one of my major caveats to somebody thinking about helping a family member buy a home is do not cosign if they don't have enough income to make the payment, unless you plan on helping them every month, because your credit is on the line. If they don't make their mortgage payment, it is going to impact your credit, just like if you didn't make your mortgage payment. So do not cosign for someone if they're having income issues, unless you can clearly see, hey, these income issues are temporary, or these income issues are not real, because there's other income coming in the door. Maybe they have a side business that they can't count, but you're confident that side business is going to do well. Just recognize when you cosign, in the eyes of the bank, we're saying, great, then if they're short, we're expecting you to pitch in. So I'm going to go back to my example here on my iPad and show you guys what happens when we have a cosigner and how we look at the income. So I'm going to pull up my screen on my iPad right now. And what you're going to see, same scenario, but now what we're dealing with, let's kind of erase this stuff over here, and we're going to add a cosigner. So the cosigner is going to have another $10,000 in income. Okay, the cosigner's debt, they have a house payment of $2,000 a month for the house. And they have a car, oops, let's put the car over there. They have a $500 a month car payment. So the cosigner has $2,500 a month in debt. We add everything together. We take the $8,000 and the $10,000 and we say, okay, so the total income for the application is $18,000. We're allowed to spend 50% of that. So times 50% means I can spend $9,000 a month towards my monthly payments. And I'm going to have $2,500 of payments with the cosigner plus $2,750 right here. So that's $5,250 of payments that are used. That leaves $3,750 for the house payment. So that gives us the maximum that you're allowed to qualify for using a cosigner. And the math is that simple, guys. We're adding everything together. So you have to make sure that you have a good cosigner. If your cosigner has a bunch of debts and not very stable income, they don't help your problem. I've had so many clients who have come to me, they have an income challenge. I said, great, I'm going to get my mom to cosign. And then we get a hold of mom. Mom's job stability isn't that great, or mom just got a job change that I can't use her new income or something, or mom's got a lot of debt. Mom owns 3 homes and mom has cosigned for other people's mortgages. Lots of different things that come up that say, you know what, that person doesn't make a good cosigner, because we have to combine your income and theirs, combine your debt and theirs, and compare it side by side. So super critical when you think about finding a good cosigner, that you need to make sure that cosigner has good credits and that they have a low debt to income ratio, because typically a cosigner is coming into play to help offset your high debt to income ratio. Theirs needs to be lower to make the overall debt to income ratio in line. Hopefully that makes sense and didn't go too deep into that. All right, so I got about 20 minutes left. I've got lots of little things that I want to talk about, and one big one that I want to talk about. But I want to encourage you, if you have questions right now, if you are watching live or if you're watching recorded, post those questions. If you have feedback or thoughts on things that you've learned, I would love to hear from you as well. What I want to talk about right now is I want to talk about cosigner versus co-borrower and title considerations. So here's the thing. I said earlier, if you wanted to give somebody money for a down payment, but you want to control whether they can refinance later, you can be an owner of the home and not be on the loan. Well, you also, when you cosign, let's say I need to use your income to qualify you. Now you have to be obligated on the loan. Most people assume that because I'm on the loan, I must be an owner of the home. That is not true. You can be a co-borrower, meaning you're only borrowing the money with them, but that your family member who's the occupant is the only owner. Now, that requires a huge leap of faith on the co-borrower's part. You are fully responsible for the debt, but you have zero ownership of the assets. Now, for some parents are like, I don't care because it's my child. All the money's going to go to them in the end, and I don't want to be involved. I don't want my name on their house. Maybe it's an issue of assets and Medicare when you get older and how much money do you have in assets, and you don't want your name on their house. I've actually had some clients who are receiving benefits from the state, and they're like, hey, I don't want to co-sign for my family member because I'll lose those benefits because now I have an extra asset of the ownership of the home. You do not have to be an owner of the home. You can be a co-borrower if you want. Most people, if your name is on the loan, you're going to want your name on the home. But there are times when we can put your name on the loan without being on the home. And there's times when we can put your name on the home without being on the loan. There's pros and cons to all of them. And it has also to do with title considerations. What happens when somebody passes away? Where does the property go? A lot of questions there that if you put somebody on title, now you're creating another, hey, mom and dad co-signed with me and their name is on the ownership of my home. But, mom is a stepmom and mom has other kids. And what if mom passes away? Does mom's ownership of my home now go through probate to her kids? Maybe. These are things you have to be thinking about when we're doing this. We can't just think about the transaction in front of us. We have to think longer term. And that's something I'm really, really good at. And I have a lot of partners who help me in this as well to be able to give you really, really good advice. So I can't give you advice right now on what the right answer is. I just want you to be aware that it's a consideration you need to pay attention to. So what are the pros and cons to co-signing? Well, here's the deal. I said it already. If you co-sign for someone, A, you're helping them become a homeowner. They're building home. They've got stability. They're building wealth through home ownership. But here's the deal. For you, you're now having your credit at risk. If they don't make the mortgage payment, it impacts your credit score. If that house goes into foreclosure, it impacts you. So be aware of the fact that this is you're fully committing to taking whatever steps it takes to help them make their monthly payment and stay current, or you're going down with that ship just like they are. So that is super, super critical to understand that fact. The other thing is, it's not as easy to get your name off the loan as what you would like. And that's one of the things that people ask me all the time is, okay, John, my parents are going to co-sign with me and they want me to, once my income's enough, they want me to take their name off of the loan. The problem is the bank is not just going to let somebody off of the loan. You have to refinance. Now let's think about this for a second. 1 year ago in 2021, interest rates were in the high 2s to low 3s. Today, they're in the low 5s. If you bought a house a year ago and your parents co-signed for you, and now you're in a position where they're like, hey, I want off that loan. The only way to get off the loan is to refinance into market rates, and today's market rates are 5+%. You're handcuffing yourself into either having them be forced to keep their name on your loan or having to take a significantly higher interest rate down the road when you don't know where market rates are going to be. It's just a fact when we think about the pros and cons that says, hey, if they want off of the loan, you don't have a choice. If you're going to get them off the loan, you have to refinance to whatever market rates are. No bank will just let them off of the loan. They signed the original agreement. They're obligated on the loan. They're not just going to let them out of it. One of the other challenges with co-signing is down payment assistance programs. I talked earlier in this video about where the money comes from and the fact that you can use down payment assistance, but some down payment assistance programs don't allow co-signers. So just be aware of that fact. If you're in a position where, hey, I'm buying a home and my parents are going to help me co-sign for buying that home because my income's not enough to make it work or my job stability isn't enough, no problem. But you're going to be precluded from using most down payment assistance programs. It's just a fact of most of the guidelines that I want to point out. Now let's transition to a super, super cool loophole, and it's a program that I call my Helping Hands program. So my Helping Hands program is designed to assist someone who cannot afford a mortgage on their own, but only under a very specific set of circumstances. And this first set of circumstances I run into all the time, and that is a parent who cannot afford the mortgage payment on their own. We see it regularly as people are aging, as housing prices are continuing to go up. You've got a parent that is struggling, and either they're a renter and you want to move them closer to you, but they don't have the income in order to qualify for a mortgage. On a conventional loan, as long as you're putting at least 5% down, I can call that an owner-occupied transaction. You can help a parent purchase a home as an owner-occupied transaction, and we get to treat the down payment like it's owner-occupied, the interest rate, the closing costs, and the monthly payment are just like their name was on the loan, but they're not on the loan at all. They're not on the ownership of the home at all. You as the child are buying or refinancing the home in your name. You can't count any rental income. You have to be able to afford that payment completely because you're helping a parent who can't make the payment on their own. So you're saying, I'm paying for it for them. I'm gonna pay for my house and I'm paying for their house. You can help a parent using my Helping Hands program to purchase a home, and they don't need to be on the loan. I don't care about their income as long as your income is enough to qualify for your debts, your house payment, and a house that you are buying for them. This is a phenomenal opportunity that keeps you from having to call it an investment property. Most mortgage people, when you describe this situation, would say, oh, well, that's an investment property because the occupant is not going to be on the loan, and they're going to force you to put your parents on the loan, which may not be good for tax consequences and estate planning. And so they're going to say, hey, this is going to be an investment property. You got higher down payment, higher interest rates, higher fees, and higher monthly payments. I have a solution to make this work. The second way the Helping Hands program works is to assist an adult disabled child. These are the rules coming from Fannie Mae, and they're very clear in saying, look, most adult children from Fannie Mae's perspective need to be self-sufficient and manage their affairs on their own. You can co-sign with them, but you can't buy something for them without their name on the loan unless they have a disability. Because the thinking is an adult disabled child is not, like in a lot of cases, not functioning, I don't want to use the wrong word here. They're not capable of managing bills on their own, managing the income on their own, but you can buy them a house of their own, give them some independence, but you're buying the house in your own name, just like we are with the parent who cannot afford it. So two circumstances: parent that cannot afford their own payment, or an adult disabled child. You can use the Helping Hands program. Really, really great opportunities to help people become homeowners. All right. The next one I want to talk about is kind of a big one. I'm probably going to take 10 minutes talking about this, and then we're going to talk about a couple of other small things after this. This one comes up regularly where I have people say, hey, John, I want to buy a house from my family. My grandpa has a house and he wants to sell it to me, or my mom has a house, or I have a house I want to sell to my kids, or I have a house I want to sell to my cousin. The concept here is the concept of a gift of equity. And it's a super powerful concept. And what happens is there's really two circumstances in which we're dealing with. One is that the family member wants full market value. The second is the family member says, look, I only want what I need out of it. Like, I want to pay off my mortgage. I want to get a certain amount of cash in hand, but I'm not worried about getting fair market value. If the seller wants fair market value, the trick I'm about to show you isn't very valuable, okay? But it is valuable if the seller is willing to sell it for less than what it would appraise for. And there's ways we can make this work. So let me pull up my iPad and let me show you kind of how these numbers are going to work in this situation. So if you have a family home, and let's say that the value of that home is $500,000, and you're trying to sell that home to a family member, and the debt, the loan, is $300,000. And I've had people walk up and say, hey, John, my uncle wants to sell me his house and he wants to sell it to me for $300,000. Okay, cool. Well, the problem is if we made the sales price $300,000, then you still have to come up with at least your 3.5% down, which is going to be $10,500. And you have to come up with your closing costs, which is probably going to be another $10,000. So you're going to have to come up with $20,500 to buy a home for $300,000. It's worth $500,000. Then you're going to say, John, that doesn't make sense. Why do I have to come up with $20,000 out of my pocket when I have a whole bunch of equity in the home? Most lenders are going to say, because that's what you're buying it for, and we can't count that equity. And it's true, we cannot count that equity unless you follow the plan that I'm about to outline. So instead of selling the home for $300,000, we're going to sell the home. First of all, we're going to sell the home for something higher. So we're going to pick a sales price of $400,000. And we're going to factor into that the fact that we have $12,000 of closing costs that are going to be paid for by the seller. Okay, so this is going to be seller paid. And we're going to have the $300,000 out of the that has to get paid off for the loan. The remaining amount is going to be a gift of equity. And so we're going to have a gift of equity of $88,000 gift of equity. And you're going to say, John, wait a second. The problem is my uncle who's selling me the house, he doesn't have this $88,000. How's he going to give it to me? Well, it's monopoly money, because your uncle, you're paying your uncle $400,000 for the home on paper. But the moment that you close escrow, the $400,000 you gave him, $88,000 of that goes right back to you as your down payment. So that money didn't have to come out of his pocket. It came out of his proceeds. And then 12,000, oops, let's not do the eraser. So, and then 12,000 of that goes to pay your closing costs. And the 300,000 goes to pay off the loan. And what's left over is zero for your family member because they wanted nothing. So you don't have to worry about the family member because they got everything they wanted. If the family member said, hey, I kind of want 30 grand out of this, no problem. We can redo the numbers and say, fine, we're selling the house for 400,000. Instead of giving $88,000 of a gift of equity, we're giving $58,000 of a gift of equity. Now your family member is still getting their 30 grand because when they sell the house for 400, we have 58,000 of a gift of equity is removed immediately, 12,000 for closing costs is removed immediately, and the 300,000 that's owed on their mortgage is removed immediately. What's left over is the 30 grand for them. That's powerful. Now here's a loophole that is a little bit off the record, but there's nothing wrong with it, which is that you can technically, let me close this out here. You can technically get a gift from your family member of some of their proceeds after the transaction closes to do some work on the house or to pay off some debt or do whatever you want. I want you to think about this for a second. I just said that we could get 30,000 extra for family. Well, what if that family member didn't want $30,000? What if that family member says, you know what, I'm totally cool. Just pay off the 300 grand and we're good. We can still leave $30,000 of proceeds that goes into the hands of the family member. When we close escrow, they have $30,000 they didn't expect. Now, legally in a purchase transaction, a seller of a home is not allowed to give you money outside of the transaction. But this is a family situation. So here's our loophole. We're not giving the money to the buyer outside of the transaction. Your uncle is giving the money to his niece and nephew outside of the transaction as a gift. So your parent gets that money if it's being sold by a parent. There's a huge loophole here. If there's enough equity in the property, I can get you extra money via extra proceeds that goes to the family member that they end up giving you at the end. So you can actually tap into the equity of the home immediately in order to get future funds to pay off debt, to do home improvements. The only caveat here is that money can't be counted towards the transaction. So if I said, hey, the only way you qualify is if you pay off this $5,000 of credit cards. Well, John, I'm going to get $5,000 from my uncle after closing using that loophole you talked about. Yeah, but I need those debts to be paid off before or during closing, and that money doesn't belong to you. The seller cannot pay off your debts other than on a VA loan. So it's a loophole that has to be used cautiously, and I can help walk you down that road. But I will tell you, there are so many times that I've talked to people who have bought a home from a family member and didn't understand this whole gift of equity thing. They wrote a check out of pocket for a bunch of money they didn't need to. They then refinanced 6 months later to pull cash out of the property, doubling their loan fees because they paid the fees when they bought the house. Then they paid fees again when they refinanced because their lender told them, hey, you can't get any money out of this. But there's some loopholes here that we can legally get you money out of it if we structure it the right way. So the point is, there's lots of options here. When you're selling or buying a home from a family member, having the ability to understand and work with someone like me who understands gifts of equity is critical. All right, a couple of things I want to cover here, and then we'll get wrapped up. If you have any questions, if you're watching live, post your questions into chat right now. I'll pull them up and answer them before we end. If you're watching recorded, post them into chat anyway. I get notified when the questions come up, and I'll make sure to go in there and answer them for you. Who can help? So here's the challenge. In almost every circumstance, we need to know that the person who's helping is a blood relative. Now, we don't take a blood test, but you sign a form that says, or write a letter that says, hey, the person I'm helping is my uncle, is my brother, is my cousin. There's actually a list of people that count. And in some circumstances, a second cousin isn't considered family. Now, John, why does family matter? Family matters because in most cases, we are allowing for this cosigner, we're allowing for this assistance because logically family is willing to help family without any expectation of money in return. But if it's just a financial transaction, if it's somebody you met last week, why would somebody you met last week give you $10,000 towards your down payment? There's something shady going on. Are they going to take an ownership interest in the property? Is it a loan that you have to pay back? So we need to know that this person is doing it out of the goodness of their own heart. And the truth is, the American way, we're not very good to people that aren't our family, and sometimes we're not very good to our family. I'm kind of kidding, and I'm kind of not. The bottom line is the industry has to draw a line somewhere and say, hey, does this make sense? Can we logically and reasonably see why this transaction is happening? There are some loopholes for what is considered a long-term friend, a long-term relationship that did not arise out of this transaction. Pretty complicated statement, but think about it. What they're saying is it's got to be a family member or a long-term relationship that didn't arise out of this transaction. So if your cosigner is your best friend, well, the problem is we need to kind of get a better explanation. Hey, this is my best friend that I've known since I was in the second grade. We actually lived together for 10 years after we graduated college, and we've helped each other through a lot of financial circumstances, and we're going to be here like brothers for the rest of our lives. Okay, that makes sense. Some lenders have literally had them say, I want to see pictures of you guys when you were kids. Well, I can give them any picture I want. That doesn't mean it's me and my buddy. But the fact is that it's a gray area. But typically it needs the person providing gift funds, the person that is co-signing, those people need to be a family member. And in some cases, we can stretch it with a close personal relationship that did not arise out of this transaction. All right, a couple other bullet points. What about refinancing? John, you've talked about purchasing, but what about refinancing of a home? I have a family member that can't refinance because they don't have enough income, but they have a 7% interest rate and they want to drop to 5%, whatever the circumstances are. Yes, you can help them in co-signing. All the things we talked about earlier, you can do. You can give them a gift to pay down their balance. You can do any number of things, including adding your name to the ownership of the home and co-signing with them, or just being a co-borrower and putting your name on the loan. You can assist family with refinancing, whether it be refinancing just to lower their payment or refinancing to cash out. We do have the same flexible options. But here's where the challenge comes in. This is the last thing I'm going to talk about, and I'm just about spot on time for my hour. I'll leave a minute here for questions at the end if there are any. So if you have questions, post them now. Otherwise, forever hold your peace. So here's the deal. We have to worry about bailout situations. As an industry, we're worried. We're worried that, hey, if a family member is behind on their mortgage and you co-sign to help them, did that really solve the problem? Okay, it's kind of like putting a Band-Aid on an axe wound. It didn't solve the problem. It's still the same person with the same struggles who couldn't make their mortgage payment before. We don't want to be stuck holding the bag. I hate to say it that simply, but the truth is a mortgage company who's the one that is last doing the loan for someone that ends up losing the home to foreclosure is like the guy in musical chairs that didn't get a chair when the music stopped. We don't want, each company doesn't want to be the last one holding the bag. And so we're not going to take on a bad loan for a bad homeowner. And that's why there's some regulations, some rules around family members who are behind on their mortgage. There's ways we can help and there's ways that we can't. There's times we can help and there's times that we can't. But just be aware the circumstances are different for each unique scenario. And if you're in that position, you have a family member that's behind and you want to help them out, give me a call. I have lots of knowledge on this. I've been doing this for 22 years. I pride myself in being an expert in the industry. And so guys, that's it for what I've got for you today. In summary, if you have any questions, please post them now. Otherwise, I appreciate those of you who are listening live and those of you who are watching after the fact. The bottom line is this is a huge opportunity to help people become homeowners that couldn't otherwise become homeowners. But there's so many ways we can do it. And you don't just need to dive in feet first and say, fine, 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 I'm going to cosign. Or fine, I'll give you $100,000. By the way, if you have $100,000 to give, I'm a recipient. I'm willing, no problem. The bottom line, guys, there's many ways to skin this cat. There's many ways to put this together. And I want to make sure that you're not taking just the option that's presented to you, because I have a lot of knowledge and a lot of history in being able to find you the right way to make this happen. So if you have questions about this or anything else, give me a holler. Know that I'm here to help you in this transitioning market to decide, hey, what strategy should I use right now to buy today? Should I refinance and pull cash out or not? I'm here to help advise you and guide you, and I'm looking forward to continuing to do so. So please like this video, please share it, subscribe to my YouTube channel if you haven't already. I'll see you next week on Friday, where I'm talking about renting versus owning and comparing whether it makes sense that you are a homeowner or whether it makes sense to be a renter. Again, full disclosure, I am team homeowner, but I will give full credit to the argument of people who say you're better off being a renter, so that we can really talk through those things and understand them. Have an absolutely wonderful week, everybody.